Back off, okay? All right. What's up, team? How we doing? So, everybody, welcome back to the stream. Apparently, YouTube didn't like us multi-streaming, which we think we found a fix to, which will be pretty sweet if we can get that going for tomorrow. We are gonna have another stream for you guys a little bit later on today. Sorry about that. We're messing around with stuff. We're trying to make we wanted to do the call-in show on both channels, which would have been pretty sick. Oh, my YouTube thing's gonna hate me today. All right, everybody, keep hitting that like button on the way in. I decided to cause a little bit of emotional damage on Twitter, and people are already getting butthurt, which is exactly what I wanted. So let's see here, team. Keep hitting that like button on the way in. Let's have some fun. We got Tesla running up a little bit here. We got Powell, 15 minutes to go until Mr. Jerome. Let's see what we get over here. You're on your Patreon app and just link your Discord onto it. So to be clear, you pay 96 now and then 49 the next billing cycle. Gabe DL, yes, you are all set to go. And a quick reminder for all you guys, so this is the last week to lock in that $49 price for the next payment period. So you would come in now. You get access to all of the things that are on platform when we do release it very, very, very soon. And that's going to be, this is the last week for you guys to be able to get access to that $49 deal. So we want to give back to all of our members that have actually enabled us to build this amazing platform for you guys. Invictus, Pythagoras, Trader Joe, all the alerts, all of the live streams, all the curriculum videos, and a lot of other special things that we have not disclosed to you guys yet that we want to be a little bit of a surprise on launch. So if you guys are interested in that and locking in that $49 monthly lifetime deal, the link is in the top of the live chat, but I will throw it in there for you guys too. Let's see. What is Powell going to talk about? I'm not sure. Ooh, dude, making money on my free trade. You guys saw it in the community over there. What are those up now? Yeah, still about 31% on that one. That is completely free. I'm going to let that ride and see where it wants to go. But again, I mean, don't get led to the fucking slaughter. Please, guys. Jesus, you cannot listen to these morons that are telling you that this thing is going to go to 80. It's just not possible. Let's see. No, who's Nolan? Let's see. He should show us the tools at this point. He talks about them so much. Yeah. Oh, what's up, team? How we doing? All right, everybody. Make sure you guys hit that like button on the way in. Let's have some fun. So 49 instead of the Patreon Discord subscription. Yes. So the $49, if you guys are already in there with us and you are a paying member, that will replace your membership. Mailbox money, you might be crazy. No. So what happens is this deal and this offer to get the $49 a month deal is for our existing members. So in order to become an existing member, you do have to get in there for 96, but every single month after, it'll only be 49. That price will drop as we transfer all of you guys over to our platform. Enjoying the replies on your Twitter? Dude, I know. Aren't they funny? Are they still going? You're not buying this at 90? No, I'm not fucking buying it, bro. Oh, my Lord. No. Jesus. Understood. Thank you. No problem. Did everybody sell? Hogan? It doesn't matter what anybody did or did not do. You have to make sure that you're doing what's best for you. You should not rely on investment decisions of other people. We as creators, it's our job to lay everything out to you guys in the most honest way possible. Now, remember, we can go through the timeline of exactly what happened. It was really great. We were all making money on AMC calls before the dividend. And what did I say? It's going to go down after the dividend. And we'll see how much by how Ape is actually dealt with by the market. We saw Ape come out. And immediately I was like, fuck no, You guys saw me live all day long. I was like, no. And then I made the videos about it. Everybody lost their fucking minds. And then there were other morons out there telling everybody that it was going to be the best thing since sliced bread and it was going to save everybody. And now, while it was a good idea, it was incredibly poorly executed on. And they've only been able to raise $30 million from it. If they go to dilute now, it is fucked. And it is continuing to be fucked. Too funny. All the bad comments. He was only 100 followers. Yeah, dude. You think I give a shit? My main goal is making money with you guys all the time. You think I give a shit about Twitter haters or fucking YouTube views? No, I don't care. Zero. Thanks for just confused. Don't check in much. Nobody talks about it much. Guess I'll keep holding and praying. Thanks for the reply. No problem, man. It's just I've tried to Why are we still talking about this? All right, we can move on. It really doesn't matter at this point. You guys have heard my thoughts every single day and when people ask. But if you guys wouldn't mind, hit that like button on the way in. And for those of you guys that are new, remember the grandfather deal is still up here. We do have Powell coming on in about 10 minutes. Let's see if we can find a link to it. That'll be fun. Look at my Twitter DM, kind of in a pickle doing the strategy right, but winning still get a shit. Oh, is it fees, buddy? Yeah, it's the fees. So you either need to trade with a larger dollar amount or set your stops in different spots. Whoa, whoa, whoa. How did the fees get you so hard on the last overall up? Never mind. Oh, on day 3. How did the fees get you so hard on that one? Were you just like flickering in and out of stuff? Sorry for the buzzkill. Hogan, no, you're good, buddy. You had a very transparent if this, then that scenario with the ape dividend, and I appreciate it. Again, that I tried so hard to help people, man. Like I tried so hard, and people were continuing to say, you're paid off, blah, 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 blah. It's like, bro, I cannot help you at this point. Like those people that were like, you're Shedgy shill, fucking da, 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 da. And look where we are. But let's see. So Spy's kind of screwed around. Also, if anybody has a link to the Powell press conference, if there actually is going to be a live stream for it, we will need that. I'll keep searching around for it. It might just come through on the news feeds. That's possible. That's what's going to happen. I listened to you, found it logical, and sold. Again, that's all I'm not going to tell you what to do. I'm going to lay out exactly what the scenarios are for what's most probable and what's going to happen. There was an crazy high amount of risk. Part shooter. Thanks for the super, buddy. I appreciate that, Brandon. One up me, bro. Oh, God. You can't. All right. We can't. Hold on. You guys don't have to send in supers, guys. Again, I appreciate it, but you really do not have to. I want you guys making money. I appreciate the supers. I definitely do. But at the same time, if you guys like, I want you guys making money. Part shooter, I know you've been crushing it, dude. I love to see that. Don't be surprised if Patreon charges us at the beginning of the month that we still have to pay $49 for the new platform. Oh, Barry, that's another thing. You're not going to get double charged right away. We've set it up in a way where we're actually delaying out the we're delaying out the $49 charge. So you this is the last time that you'll pay the 69 or 96, depending on which one you are. And then we've delayed out the 49 for the next payment period. Because we didn't want you guys getting like the 96 and then immediately a 49, because that's not fair. Justin, thanks for the super chat, please. Please, guys, you don't have to do that. You don't have to do that, guys. Yeah, the Twitter nonsense is great. Oh, I love it, dude. This Twitter shit is funny. Again, it's like at this point, it's like, what am I like? People have already said nonsense. It's like, all right, well, I'm just going to make everybody continually look stupid for the things that they say. All right, Apple slipping a little bit lower. We got 7 minutes until Powell starts talking. Let's see. Yeah, Hogan, I agree with you. You're in the original 69. Do I need to do anything extra moving forward? No. The only thing that you have to do is just make sure that you've actually been charged, because after hours today, remember, we had that little random freeloader issue. It's not your guys' fault at all. It's a Patreon issue, and we're going to figure it out with them. But we are going to be revoking access to those accounts that have slipped through the cracks after close, I believe, today. So just make sure that you have everything set up. If you end up getting like unnecessarily kicked out, you can just link your Patreon account right back in. C Money, thanks for the super. Jesus, guys, you do not have to do this at all. You're back. The SEC decided to let you go. What happened to the stream earlier? YouTube didn't like the fact that we were multi-streaming. Sent you the J Powell link on Twitter. Thank you. See, teamwork makes the dream work. I don't think you have. I think you sent it to the wrong STV. So my Twitter is short to Vix1. I see what you're doing. Now I get it. Now I understand. Yeah, never mind. You're good. Yeah, so we'll watch this for a little bit. This will be pretty interesting. What is this platform thing you're talking about? Separate from Discord? Yes, like 2 separate. Well, or is our Discord price going from 69 to 49? So just a quick rundown. We have built this essentially all-in-one platform for retail investors right now for trading, and we're going to release it to you guys. We're going to be able to build lots of things on top of this too. Remember how I talk about it in phases, phase 1, phase 2, phase 3. In my mind, I'm not going to tell you what's in the next phases because, again, as you guys have seen from that video that Gabe and I did about all the bullshit that we've had to go through, I'm not going to tell you guys what the next couple of phases are, but they're really cool. Again, I like coming up with ideas and things that are actually going to help people make money in the market. And a few of these things that we're going to be making on top of this platform are going to be really, really, really cool. So it is going to be its own platform separate from Discord. We will still keep the chat function for the time being on Discord open. So we have a little bit of a community there. But most of the things are going to be done on platform. So again, all of you guys that are in there right now that are already paying members, you'll get access to everything that we're ever going to do in the future. For that 49 if you are a current member. So if you guys are interested, the link's in the top of the live chat. If not, perfectly okay. Let's see. Daily Taylor, thanks for the super buddy. I love a rebellious super chat. Thank you. No, not two different subscriptions. Not two different. So it goes from 69 or 96 to 49. When do we have access to that? Very, very, very soon. SV, you were one of the few people that made me pumped to trade. Just not a fan of when we flip to the drama and not the market. Yeah, I got you, buddy. Shelly, how you doing? Yeah, I mean, Leo, we do have to deal with shit sometimes. So sometimes it just needs to happen. Let's see though. All right. So do I have this link somewhere? Yeah, I got it right here. Cool. So we'll have Powell ready to go in a few minutes. We are going to be watching this for a little bit. Again, guys, if you wouldn't mind hitting that like button on the way in, helps get these streams out to a couple of more people over here. Let's see. YouTube glitchy today? Yeah. Yeah, it is. I understand. Yeah, Leo. Sometimes you just got to do what you got to do. Because the thing is that narratives like to spread and they're just completely false. Like, remember, people like this to think that, like, this is how dumb it gets. People think that I've been paid off by a fucking hedge fund. Like, that's how dumb some people are. Share the link. I mean, we're going to stream it here. If you want the link, it's just search. Where is it? It's the CNBC television live. Fed Chair Powell speaks at the Brookings Institute on economic outlook. Who cares about the outside noise? See, this is what some of you guys don't get about social media. Will the platform have charts too? For the time being, you will still need TradingView. But again, this is in phases, remember, team. Hogan, thank you so much for the super, buddy. Sorry for opening the can of AMC worms. I'll chip in on launch. Dude, thank you, buddy. I appreciate that. And again, I'm always down to answer questions for you guys. Again, I've done everything that I can. I tried to explain everything to everybody in the most simple way that I possibly could. Some people just don't like to hear it though, which is fine, but it's my job as a creator with an audience to make sure that I'm not leading you guys to the slaughter. Some people out there, and you know, a lot of them don't really care. They're going to do what they're going to do at the end of the day. That's fine. It's their prerogative to do whatever they want to do with their platform and use people for clicks and views. It's whatever they want to do. But at that point, that's not for me. Let's see. Will the Discord become free then? I mean, you might, we'll think about that, but there won't be like alerts in there. If that ever happens, you won't have alerts in there. Sheep people. Yeah, I mean, again, it's not necessarily that, it's hope. That's what it is. It's hope, which, I mean, it is what it is at the end of the day. Everybody has hope. No Invictus yet? No, I mean, we've had a lot of Invictus alerts today. Some of them have played out pretty nicely. Rita's up nicely today, too. You're turning into a boomer. Yeah, let's see. All right, 1 minute to go. We're about to get some Powell live. All right, team. We're 9 likes away from 102. I appreciate it, everybody. And thank you guys all for the supers. You guys know you don't have to do that if you don't want to, but I really appreciate that. The whole market is hope ignorant. Nope. Not when there's a giant inherent risk over one thing over another. And what a lot of people are doing, and what I like to think of it as, is like, if your girl's cheating on you and your boy is like, bro, this lady is ruining you. I was going to say a different word, but, and then everybody's like, nah, fuck you, bro. I'm not talking to you anymore. That's essentially what goes on. For all that have been paying for the past 6 months, is there a possible chance of getting kicked out today? Cracks and all? You shouldn't be. You should be fine. Do you need any development help for the platform? We might. It depends on who you are. We are probably going to end up bringing some more people on eventually. But if you are interested in, oh, here comes Powell. Sorry. If you're interested, that's not going to be in my end of things, but I can set you up with the right people, and we can get you an interview. All right. Powell is not out yet. But I have the stream up here live. We're going to let this thing fly. Whoa, 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 whoa. He hasn't even fucking said anything. Relax. He said nothing. Fucking chill out. Wait, how is he talking already? Hold on. Is this delayed on this stream?
Good afternoon. I'm Glenn Hutchins, co-chair of the Brookings Board. And on behalf of our president and some of my fellow trustees who are here in the audience today, it's my great pleasure to welcome all of you. Both our post-pandemic in-person audience here, packed house, great to see, as well as our sizable broadcast and online audience. Thank you for joining us today. When President Obama named Jay Powell to the Federal Reserve Board as governor in 2012, no one, including I suspect Jay, expected him to become Fed chair. When President Trump named Jay Powell Fed as the Federal Reserve
This is delayed somehow.
In 2018, hardly anyone anticipated a global pandemic. And don't forget that then the Fed's challenge was too little, not too much inflation. So Jay Powell has repeatedly been forced to confront the unexpected and had to steer the United States economy through uncharted waters. He's done it with a steady hand, great personal integrity, independence, and an unwavering commitment to the Fed's dual mandate, price stability, and maximum.
Nowhere has it live.
Employment, though I don't think I need to explain any of you that today, despite stiff headwinds, both economic and political. So we're pleased to welcome to the stage today, on behalf of the Brookings Institution and the Hutchins Center on Fiscal and Monetary Policy, Jay Powell. Following his remarks, Mr. Powell will field questions from David Wessel, the director of the Hutchins Center, and from the audience. Jay, thank you for joining us.
Yeah, this isn't even worth watching. Hold on. This isn't even worth watching because it's delayed. So because they just put him on there, and we're getting like alerts from like him talking. So hold on. That's bullshit. That's not even relevant. Powell, time for moderating hike pace may come as soon as December. Rate peak likely somewhat higher than September forecast. Powell says Fed will need restrictive policy for some time. This candle might be bullshit here. Watch out. So Powell, like that was what was coming out 2 minutes ago. Powell link. Okay, hold on. I think I have a better one here. All right, let me see if I can find a better one. Because that's CNBC. Fuck you, honestly. That's nonsense. Here it is right here. Yeah, this is better. Whoa, 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 whoa.
Inflation for purposes of this discussion,
can we shut the fuck up, please? Thank you.
PCE inflation, which omits the food and energy inflation components, which have been lower recently, but can be quite volatile. Our inflation goal is for total inflation, of course, as food and energy prices matter a great deal for household budgets. But core inflation often gives a more accurate indicator of where overall inflation is heading. 12-month core PCE inflation stands at 5.0% in our October estimate, approximately where it stood last December when policy tightening was in its early stages. Over 2022, core inflation rose a few tenths above 5%, and it fell a few tenths below, but mainly it moved sideways. So when will inflation come down? I could answer this question by pointing to the inflation forecasts of private forecasters or of FOMC participants, which broadly show a significant decline over the next year. But forecasts have been predicting just such a decline for more than a year, while inflation has moved stubbornly sideways. The truth is that the path ahead for inflation remains highly uncertain. For now, let's put aside the forecasts and look instead to the macroeconomic conditions we think we need to see to bring inflation down to 2% over time. For starters, we need to raise interest rates to a level that is sufficiently restrictive to return inflation to 2%. There's considerable uncertainty about what rate will be sufficient, although there's no doubt that we've made substantial progress, raising our target range for the federal funds rate by 375 basis points since March. As our last post-meeting statement indicates, we anticipate that ongoing increases will be appropriate. It seems to me likely that the ultimate level of rates will need to be somewhat higher than thought at the time of the September meeting and the summary of economic projections. I will return to policy at the end of my comments, but for now, I'll simply say that we have more ground to cover. We're tightening the stance of policy in order to slow growth in aggregate demand. Slowing demand growth should allow supply to catch up with demand and restore the balance that will yield stable prices over time. Restoring that balance is likely to require a sustained period of below-trend growth. Last year, the ongoing reopening of the economy boosted real GDP growth to a very strong 5.7%. This year, GDP was roughly flat through the first 3 quarters, of the economy, and indicators point to modest growth this quarter, which seems likely to bring the year in with very modest growth overall. Several factors contributed to this slowing growth, including the waning effects of reopening and of pandemic fiscal support, the global implications of Russia's war against Ukraine, and our policy actions, which tightened financial conditions and are affecting economic activity, particularly in interest-sensitive sectors such as housing. So we can say that demand growth has slowed, and we expect that this growth will need to remain at a slower pace for a sustained period. Despite the tighter policy and slower growth over the past year, we have not seen clear progress on slowing inflation. To assess what it will take to get inflation down, it's useful to break core inflation into 3 component categories: core goods inflation, housing services inflation, and inflation in core services other than housing. Core goods inflation has moved down from very high levels over the course of 2022, while housing services inflation has risen rapidly. Inflation in core services ex-housing has fluctuated, but shown no clear trend. And I'll discuss each of these items in turn. Early in the pandemic, goods prices began rising rapidly as abnormally strong demand was met by pandemic-hampered supply. Reports from businesses and many indicators suggest that supply chain issues are now easing. Both fuel and non-fuel import prices have fallen in recent months, and indicators of prices paid by manufacturers have moved down. While 12-month core goods inflation remains elevated at 4.6%, it has fallen nearly 3 percentage points from earlier this year. It is far too early to declare goods inflation vanquished, but if current trends continue, goods prices should begin to exert downward pressure on overall inflation in coming months. Housing services inflation measures the rise in the price of all rents and the rise in the rental equivalent cost of owner-occupied housing. Unlike goods inflation, housing services inflation has continued to rise and now stands at 7.1% over the past 12 months. Housing inflation tends to lag other prices around inflation turning points, however, because of the slow rate at which the stock of rental leases turns over. The market rate on new leases is a timelier indicator of where overall housing will go over the next year or so. Measures of 12-month inflation in new leases rose to nearly 20% during the pandemic, but have been falling sharply since about mid-year. As Figure 3 shows, however, overall housing services inflation has continued to rise as existing leases turn over and jump in price to catch up with the higher level of rents for new leases. And this is likely to continue well into next year. But as long as new lease inflation keeps falling, we would expect housing services inflation to begin falling sometime next year. Indeed, a decline in this kind of inflation underlies most forecasts of declining inflation. Finally, we come to core services other than housing, and this spending category covers a wide range of services, from healthcare and education to haircuts and hospitality. This is the largest of our 3 categories, constituting more than half the core PCE index. Thus, this may be the most important category for understanding the future evolution of core inflation. Because wages make up the largest cost in delivering these services, the labor market holds the key to understanding inflation in this category. In the labor market, demand for workers far exceeds the supply of available workers, and nominal wages have been growing at a pace well above what would be consistent with 2% inflation over time. Thus, another condition we're looking for is the restoration of balance between supply and demand in the labor market. Signs of elevated labor market tightness emerged suddenly in mid-2021. The unemployment rate at the time was much higher than the 3.5% that had prevailed without major signs of tightness before the pandemic. Employment was still millions below its level on the eve of the pandemic. Looking back, we can see that a significant and persistent labor supply shortfall opened up during the pandemic, a shortfall that appears unlikely to fully close anytime soon. Comparing the current labor force with the Congressional Budget Office's pre-pandemic forecast of labor force growth reveals a current labor force shortfall of roughly 3.5 million people. This shortfall reflects both lower than expected population growth and a lower labor force participation rate. Participation dropped sharply at the onset of the pandemic because of many factors, including sickness, caregiving, and fear of infection. Many forecasters expected that participation would move back up fairly quickly as the pandemic faded. And for workers in their prime working years, it mostly has. Overall participation, however, remains well below pre-pandemic trends. Some of the participation gap reflects workers who are still out of the labor force because they're sick with COVID-19 or continue to suffer lingering symptoms from previous COVID infections or long COVID. But recent research by Fed economists finds that the participation gap is now mostly due to excess retirements, that is, retirements in excess of what would have been expected from population aging alone. These excess retirements might now account for more than 2 million of the 3.5 million person shortfall in the labor force. What explains these excess retirements? So health issues have surely played a role, as COVID has posed a particularly large threat to the lives and health of the elderly. In addition, many older workers lost their jobs in the early stages of the pandemic when layoffs were historically high. The cost of finding new employment may have appeared particularly large for these workers, given pandemic-related disruptions to the work environment and health concerns. Also, gains in the stock market and rising house prices in the first 2 years of the pandemic contributed to an increase in wealth that likely facilitated early retirement for some people. The data so far do not suggest that excess retirements are likely to unwind because of retirees returning to the labor force. Older workers are still retiring at higher rates, and retirees do not appear to be returning to the labor force in sufficient numbers to meaningfully reduce the total number of excess retirees. So, the second factor contributing to the labor supply shortfall is slower growth in the working age population. The combination of a plunge in net immigration and a surge in deaths during the pandemic probably accounts for about 1.5 million missing workers. Policies to support labor supply are not the domain of the Fed. Our tools work principally on demand. And without advocating any particular policy, however, I will say that policy to support labor force participation could, over time, bring benefits to the workers who join the labor force and support overall economic growth. Such policies would take time to implement and have their effects. For the near term, a moderation of labor demand growth will be required to restore balance to the labor market. Currently, the unemployment rate is at 3.7%, near 50-year lows, and job openings exceed available workers by about 4 million. That is about 1.7 job openings for every person looking for work. So far, we've seen only tentative signs of a moderation in labor demand. With slower GDP growth this year, job gains have stepped down from more than 450,000 per month over the first 7 months of the year to about 290,000 per month over the past 3 months. But this job growth remains far in excess of the pace needed to accommodate population growth over time, about 100,000 per month by many estimates. Job openings have now fallen by about 1.5 million this year, but remain higher than at any time before the pandemic. Wage growth, too, shows only tentative signs of returning to balance. Some measures of wage growth have ticked down recently, but the declines are very modest so far relative to earlier increases and still leave wage growth well above levels consistent with 2% inflation over time. To be clear, strong wage growth is a good thing, but for wage growth to be sustainable, it needs to be consistent with 2% inflation. So let's then sum up this review of economic conditions that we think we need to see to bring inflation down to 2%. Growth in economic activity has slowed to well below its longer run trend, and this needs to be sustained. Bottlenecks in goods production are easing, and goods price inflation appears to be easing as well, and this too must continue. Housing services inflation will probably keep rising well into next year, but if inflation on new leases continues to fall, we will likely see housing services inflation begin to fall later next year. Finally, the labor market, which is especially important for inflation in core services ex housing, again accounting for more than half of the category, shows only tentative signs of rebalancing, and wage growth remains well above levels that would be consistent with 2% inflation over time. So despite some promising developments, we have a long way to go in restoring price stability. Returning to monetary policy, my FOMC colleagues and I are strongly committed to restoring price stability. After our November meeting, we noted that we anticipated that ongoing rate increases will be appropriate in order to attain a policy stance that is sufficiently restrictive to move inflation down to 2% over time. Monetary policy affects the economy and inflation with uncertain lags, and the full effects of our rapid tightening so far are yet to be felt. Thus, it makes sense to moderate the pace of our rate increases as we approach the level of restraint that will be sufficient to bring inflation down. The time for moderating the pace of rate increases may come as soon as the December meeting. Given our progress in tightening policy, the timing of that moderation is far less significant than the questions of how much further we will need to raise rates to control inflation and the length of time it will be necessary to hold policy at a restrictive level. It is likely that restoring price stability will require holding policy at a restrictive level for some time. History cautions strongly against prematurely loosening policy, and I'll close by saying that we will stay the course until the job is done. Thank you.
Thank you very much, Chair Powell. I think you spared me the chore of asking you to pick between 50 and 75, so I won't have to ask you that. Thank you for your last paragraph. But I want to talk a little bit about wages and inflation. So, as you said, wages are rising faster than is consistent with a 2% inflation rate, assuming reasonable productivity. You said in November that wages are not the principal cause of prices going up. But for many workers, real wages have been falling lately. So I wonder, isn't there room for wages to rise a bit faster so workers can make up lost ground? And what level of wage increases do you think is consistent with a 2% inflation target?
Okay, so
Good question.
I guess I would start by saying that the inflation that we saw at the beginning of this episode back in March of 21 was not really related to wages at all. It was related to tightness in goods markets, largely due to supply chain issues. Over time, though, inflation has now spread broadly through the economy. And while I would still say that the inflation we're seeing now is not principally related to wages, we think that wage increases are probably going to be a very important part of the story going forward, particularly as it relates to that third category of core services ex housing. So we think it is an important thing going forward. And ultimately, in the service sector in particular, where wages and benefits are by far the largest cost, wages need to go up. And of course, we want wages to go up. We want wages to go up strongly, but they've got to go up at a level that is consistent with 2% inflation over time, making basic assumptions about productivity. So if you look at the principal wage measures that we look at, I would say that you're 1.5 or 2% above that with current wage increases. So particularly the employment compensation index and the average hourly earnings index. Look at those two. It's about 1.5% higher than what would be consistent, making various adjustments, including for productivity, from nominal wages. So, and as we look at the labor market today, including today's JOLTS data, what you see is a labor market that there's a real imbalance between supply and demand. There are 1.7 job openings for every unemployed worker, everyone looking for a job. The so-called jobs workers gap is about 4 million, meaning if you look at all of the available jobs, including people who are working, and then look at people who are in the labor force or looking for a job, there's a 4 million shortfall. So you're in that world, and we think that there's a job for moderating demand in there and getting the labor force back into balance.
You don't think that there's a possibility that we should have a period of catch up of wage increases above the sustainable level, and that businesses with relatively fat profit margins can absorb some of that without passing it through?
So that's the question of the worker share of profits and that kind of thing is not really related to this. Right now, people's wages are being eaten up by inflation. So what you want to do is you want to have inflation stable and then have a very strong labor market where the biggest wage gains are going to the people at the bottom end of the spectrum. And we had that at the end of the very long expansion that ended with the pandemic. That's not what we have now. Now, for most workers, the increases they're getting in wages are being eaten up by inflation. That's actually not true at the bottom end, where wage increases are higher than inflation. And that's a good thing. But if you want to have sustainable, strong labor market, where real wages are going up right across the wage spectrum, especially for people at the lower end, you got to have price stability. And until we restore that, we can't get back to that place where we kind of were for the 2 years before the pandemic hit.
And did you take, when you looked at today's JOLTS data, which measures the vacancies and quit rates, did you find that encouraging?
More or less in line with expectations, but that's
going in the right direction.
That's a good thing, right? So yeah, I guess job openings came down by several 100,000 to where they are now, and yeah, that's a positive thing. As you know, the relationship between job openings and unemployment is a very fraught one, and job openings right now compared to unemployment are at near their all-time high levels. So it has been our view that there's a possibility that in this highly unusual situation in the labor market could come back into balance to some extent through a decline in job openings, and that there's been a typical relationship between increasing unemployment and declining job openings, but that our thinking has been, and many labor economists share this, that you could get a decline in job openings that wouldn't produce the same increase a smaller increase in unemployment than is typically the case looking back in history because of the very outsized level of job openings. And we've kind of seen that so far, but it's way too early to say that'll work.
Traditionally, the Fed looked at the unemployment rate as a measure of labor market tightness, and we've seen recently that may be misleading. Unemployment rate is still very low, and as you pointed out, job vacancies is starting to come down. But to the extent that the Fed still relies on a Phillips curve kind of relationship, going forward, is the natural rate of unemployment a useless concept? What measures will the Fed use to judge labor market slack as we look ahead to policy in the coming years?
So I think the way we think about it, of course, the standard way to think about it is it's the gap between the actual unemployment rate and the natural rate of unemployment that matters, right? And the issue really, it's not that framework doesn't make sense, it does make sense. But the issue is that the natural rate of unemployment is very hard to identify with certainty, even in normal calm times. But when there's a violent disruption of the labor market, it can move very substantially. So, and that happened at the beginning of the pandemic. You had the labor market was very much disrupted, and we assumed that the natural rate had moved up, meaning that for any level of unemployment, the labor market is tighter. So we knew that. And I think what was different in this cycle was really that you had to look at things like job openings and quits and reservation wages and just wages overall to tell you that the natural rate of unemployment had really moved up quite a lot. But I don't think it's a problem with the framework, but it is a fact, though, that it's very hard to pin down where the natural rate of unemployment might be when there's this massive disruption in the labor market going on.
So do you think that the JOLTS data, the job vacancies per unemployed worker, that's going to be a lasting measure of labor market tightness for you at the Fed?
Yes, I think people will tend to look at it.
Well, when you tell them you're looking at it, they tend to look at it.
They'll look at it.
I've noticed that.
That's right. I would just say in this particular situation, we think it's important, and we're going to find out empirically whether that was true for the reasons I explained. We think that we can see a big decline in job openings and less than you would expect of an increase in unemployment. So this was a unique in so many different ways. Right. This series of events was different from One in particular is just that so much of the inflation was due to supply side constraints,
Right.
which is not a feature of the U.S. economy for a long time.
Well, but Vice Chair Lael Brainerd said the other day in a speech that she raised the question of whether long-term changes of the economy, like labor supply, deglobalization, climate change, could reduce the elasticity of supply, and that this may be a problem going forward. Do you share that?
So this is a great set of questions that we've all been thinking about a lot. And Lael's speech was really terrific on that. Augustine Carstens has given a couple of speeches on the same topic, including one at Jackson Hole this year.
The head of the Bank for International Settlements.
Yes, exactly. The question is, is the new normal going to be unlike this normal that we've had, where supply side disruptions and constraints were relatively, you could look through them. The lore has been for a long time that you don't need to worry about that. It'll sort itself out. A supply shock from oil prices or whatever. Are we going into a situation a little bit like the 70s, where there will be ongoing repeat shocks, and which would tend to put more upward pressure on inflation over time? We don't really know. I mean, it's a great question. But the question, I guess the real question is, if that's true, what are the implications? We still have a 2% inflation target, and we still have to use our tools to achieve it and to keep inflation expectations anchored. But it's very hard to know. It's very hard to know the answers to these things. I mean, we tend to assume things will go back to the way they were just naturally, but that doesn't seem to be happening so far.
Right. Now, you mentioned in your remarks that forecasts of inflation have, not only those at the Board of Governors, but in the private sector as well, have been lousy. Inflation has not behaved the way the forecaster said. So I wonder how you think about using forecasts of inflation and making policy. If you can't tell us, or if your staff can't tell you with some degree of confidence what inflation is going to be 6, 12, 18, 24 months out, how do you think about that in deciding when you make policy decisions?
So I'll say that it is very difficult to forecast inflation now, and one of the reasons is just that the situation is so different from the normal one. And as I mentioned, a lot of it is just that the difficulty is just these supply side constraints that we've had. We had no experience in forecasting that. It was, this was a case of first impression. So that was very difficult. Nonetheless, we do make forecasts. We'll continue to make forecasts. The way I tried to get around that in my remarks was to say, let's put the forecasts aside for a second, and let's try to identify the macroeconomic conditions that we think we need to see that would put downward pressure on inflation. So that's a way to think about it. We'll continue to make forecasts, but we're going to have to be humble and skeptical about forecasts, I think, for some time. And that calls for a lot of risk management. And the other difficulty, of course, is that monetary policy works with long and variable lags, in particular inflation is at the end of that train. And so if you're waiting for actual evidence that inflation is coming down, it's very difficult not to over tighten if that's all you're doing. So we have a risk management balance to strike. And we think that slowing down at this point is a good way to balance the risks of
slowing down on the pace of rate
hikes.
Yeah, like that doesn't. You're still going.
It's still a problem if you can't use today's inflation rate to set policy, and you're not sure what tomorrow's inflation rate is. You're saying the inflation forecast will be set.
Bro, okay. The Powell is essentially just saying some of the things that he's always said, but the market's really reacting positively to, what do you call it? Just the slowing the pace of rate increases, which we've been over this a lot, is not what people need to be looking at. It's the actual terminal rate. But I do have some news for you guys right now. So you guys know all about Invictus. And again, if you guys haven't already, if you wouldn't mind hitting that like button on the way in. Dude, Invictus is having a 90% day today. 90%, dude. That's Algo, if you're in here, what is Rita at, bro? What is Rita at? Oh, we got a lot of slackers on the like button. I see you guys. That's ridiculous, bro. So again, guys, if you do want access to all of that, make sure that you guys check out the link at the top of the live chat. If you pay 96 for this month, remember the next month drops to 49, and that's only available to all of our members in our community. Invictus, Pythagoras, Trader Joe, all these tools are killing it right now. These proprietary algorithms are wild. So, and again, this week is the last week. Really, tomorrow's the last day to lock in that deal and make sure that you are in there for when we are offering this. So the link is at the top of the live chat. It's also in the description as well. So make sure you guys check that out. Today and tomorrow is really the last 2 days where that's going to be available for all of you guys to get essentially grandfathered in at $49 a month. So if you guys are interested, check that out. But we are going to be wrapping up here right now. But what we are going to do, though, is going right over to Gabe's channel over here. Gabe and I are going live at 2. So right now, make sure you guys head over there. We are YOLOing over there. I'm going to end this one, head over there. But remember, team, this is a crazy day. We did say a lot of volatility was going to be coming. It's going to wrap it up here. Bro, the speech. Dude, he's just saying everything that everybody knows. It's the speech is not giving us any new information. But it's going to wrap it up over here. We're going to be doing call-ins over there. So make sure you guys hit that link. We're going to be going to have fun. Let's do it, team. Other than that, peace.